it's fantastic that central bank buying, and I think other whales, other.
You're watching Silver News Daily. Subscribe for more.
Did you know that the Federal Reserve's recent rate cut could send silver prices skyrocketing? I know it sounds crazy, but let me explain why this might actually be the perfect storm for a massive silver rally. With both industrial and retail investors eyeing silver like never before, and now the Fed slashing rates by 0.5 percentage point, we could be witnessing the start of something huge. But that's not all. There's one surprising factor in this equation that nobody's talking about, and it could be a key to unlocking silver's explosive potential. Stay tuned, because in this video, we're diving deep into why Lobo Tigger believes silver could be on the verge of a historic breakout.
Stocks. But the world of economics is so muddled, and the models out there that the mainstream uses are so broken. The wrong way Corrigan's out there make any sensible investor have to go and think and become something of an amateur economist himself. So I'm not afraid to go there, but I do like to put that caveat out there. You know, I'm not a PhD in economics. Maybe that's a good thing. So caveat aside, as we're recording now, it's CBI Day Eve. I don't know when this will go live, but this is all much on our minds. And a couple very simple points. One is the famously long and variable lags. The average length of those in the U.S. between the initiation of a rate tightening cycle and a recession is around 27 months. So the average length, you know, there are a lot of people, you know, as you've said, I've been in the hard landing camp for a while. A lot of people saying, oh, well, it hasn't shown up by now. Lobo, you and your tinfoil hat crowd can just go and pound the sand. If it hadn't happened yet, it's not going to happen, blah, blah, blah. But those were all very ignorant statements. I mean, okay, I thought, given how much the Fed tightened so quickly, honestly, I thought that there would have been fireworks before now, and I was wrong. I'll admit that. But back to my point, the average delay of these long and the variable lags is 27 months, which would have come due last July. And lo and behold, I'm not saying that, you know, that proves anything, but lo and behold, in July is when we started to see the cracks appear in the labor market. And what we've got now, this is important, Elijah. This isn't just, oh, cracks are appearing. They started almost right on schedule in July, and they widened, and they're widening more now. This is not just a data point. It's not something that can be dismissed. It's now a trend. And if you look at, whether you look at a SOM rule chart or, you know, my favorite, the Gunlock indicator, the long-term sort of 3-year average unemployment versus spot unemployment, if you will, when these charts, when unemployment curves up, that's the recession indicator. And by the way, both SOM and Gunlock indicators.
When the Federal Reserve decides to cut interest rates, it's like throwing fuel on the fire for precious metals, especially silver. Historically, silver has shown a strong tendency to appreciate following rate cuts, and the data speaks for itself. Let's take a quick trip down memory lane. In the early 2000s, we saw a series of rate cuts that propelled silver prices upward by 11.5% within just 6 months. Fast forward to the aftermath of the 2008 financial crisis, another round of aggressive rate cuts, and what happened? Silver surged by over 20% in less than a year. And the trend didn't stop there. The pandemic-induced rate cuts in 2020 sent silver soaring by a staggering 4 to 7% over the next 12 months. But why does this happen? It all comes down to the opportunity cost of holding non-yielding assets. When the Fed cuts rates, returns on savings and bonds become less attractive, driving investors to seek alternatives. Precious metals, particularly silver, become a haven for preserving wealth. And this isn't just a short-term reaction. The effects can last for months or even years, as we've seen in the past. The most recent rate cut by 0.5% is a signal that the Fed is serious about stimulating the economy, even if it means putting more pressure on the dollar. With silver already up by 2% just 3 months after the announcement, we could be looking at an even more dramatic climb over the next 6 months. If history is any guide, the stage is set for a significant upward movement. So here's the big question. Could we see silver replicating its previous gains or even outperforming them? And if so, how can savvy investors position themselves to ride this wave? Stay with us as we break down the factors at play and explore why silver might just be the best investment opportunity right now. And don't forget, if you find this information valuable, make sure to hit that subscribe button and join us as we continue to monitor this unfolding story.
Are coincident, not leading indicators. They're telling us that we're in recession now, even if the powers that be won't recognize it until next year or whenever, if ever. But these rules have a very strong track record. The Gunblack one goes back 80 years. There's an unbroken, successful track record of nailing coincident recessions before the powers that be admit it. So, and people say, oh, well, how can that be? We've got such a great economy. Not really. If you have the rose-colored glasses that Janet Yellen seems to only ever wear, and it's funny, if you wear red, then how do you see red lights flashing? She said just yesterday, as you and I speak, that she sees no red lights flashing. Well, I mean, when unemployment starts going like this, it's silly, not just, okay, it's stupid to say that, oh, it's still low. Yeah, but the point is, where's it going? It's going steeply up. It's accelerating upwards. That is bad. The fact that it's still low, but it's going up, the trend matters. Plus, these indicators that we're talking about, when it does this thing, when it starts pulling a hockey stick, it never just stops and goes right back down again. It doesn't happen. It's not in the data. Deteriorating conditions tend to exacerbate, tend to become a vicious cycle. So there's a lot of different ways I can go with this, Elijah. But basically what I'm saying is, for all those people that were dismissing me and saying, Lobo, you're just a perma-bear, you're just so negative, you only look at the negative. Well, I think the mainstream cheerleaders are too positive. So I see it as partly my job to balance that with some of the negative that they just don't see with their rose-colored glasses. And now I think the totality of the data, to use Powell's phrase, is starting to be, pretty obviously on my side. And it's not just the labor market. That's the pillar of American exceptionalism. So it's very important to see the labor market caving. But it's also been a manufacturing recession. The U.S. has been in manufacturing recession for a long time, not just 2 quarters, right? But a long time. And we've had this trucking recession. Commodities are telling you, that's a massively flashing red light. Dr. Copper, with the PhD in economics, is way down. This is all telling you. There's a lot more I could go into, but I think any reasonable person who tries to look at what's really going on has to see the red lights out there flashing, and they should invest accordingly.
Now, let's talk about one of the most telling indicators for silver's potential, the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold, and historically, it's been a powerful tool for identifying whether silver is undervalued compared to gold. At the beginning of 2023, the gold-silver ratio was at a staggering 90:1. This means gold was 90 times more expensive than silver. For some perspective, the 50-year average for this ratio is around 50:1. So what does this tell us? It's like a flashing neon sign that silver is significantly undervalued. Fast forward to today, and the ratio has tightened to about 83:1, signaling that silver is starting to catch up, but there's still a long way to go. If silver were to move closer to its historical median, we could see its price rise dramatically. And get this, if the ratio falls back to 50:1 and gold stays around its current levels, silver could jump to over $1.50 an ounce, right around its all-time high. That's nearly a 50% increase from where it is now. But it gets even more interesting. If we adjust for inflation, silver's true high should be closer to $1.145. Yes, you heard that right, $1.145. With the current economic environment, rising debt, and continued money printing, that target is becoming more realistic by the day. So what's driving this shift? It's a combination of increased demand from both industrial applications and retail investors looking for a safe haven. And with the Fed's recent rate cut, the conditions are perfect for silver to close the gap with gold even further. But let's take a step back. Why does this gold-silver ratio matter to you as an investor? Because historically, when the ratio is this high, It has signaled a massive opportunity for silver to outperform. And for those paying attention, this could be a once-in-a-lifetime chance to capitalize on a potential silver boom. Are we about to see a silver breakout? And if so, how can you best position yourself to take advantage of it? We've got more insights and strategies coming up, so stay with us. And if you're finding this analysis valuable, don't forget to subscribe and hit the notification bell so you don't miss any updates.
To be fair again, or try to be as honest as I can, my thesis here for a long time that you and I have spoken about was that the Fed was going to break something. So if you go by the mainstream economic perspective, yes, the Fed should be cutting, arguably should have cut already. If what I'm saying about the SOM roll and the gun luck indicator, if all that's right, they should have been cutting already. Trends don't just stop on a dime, not just this unemployment uptick that I'm talking about, but let's say inflation. If the economy is cooling and that's bringing inflation down, you can't just say, oh, we're at 2%, we'll stop now, and that's fine, right? Whatever you did that made the bow of the ship swing ever so slowly in the direction you want, it doesn't just stop right there. So there is good reason, again, according to the mainstream outlook, to ease up on the brakes before you get to the goal. And arguably they should have already. But my thesis was that something would break, and that hasn't played out yet, or part of my thesis. The other part of the thesis, though, is that regardless, rate cuts are good for gold and silver, monetary metals. So whether I was right or wrong about the hard landing or the reasons why, when the rate tightening cycle turned into a rate cutting cycle, that was going to be bullish. Now, I thought that might happen actually around now, but earlier when I was forecasting for 2024, and I said, this will be the year for gold. Last year it was uranium. This year it was gold. I didn't think it would happen until about now. But I thought that's when things would start breaking more. That hasn't happened. So what that means, though, is it's interesting because the other reason of rate cuts, recession becoming more undeniable, that's coming into play. But we're not at 1900 or 2000 gold when I made that call. We're now going into that at 2500. So the reasons to be bullish on gold are still ahead of us. And by the way, the Fed breaking something, it hadn't happened yet, but that doesn't mean it's not going to. So the way I see it is rate cuts alone are good for gold. Undeniable recession, that'll be good for gold. We may or may not get that undeniable recession. I think we will. I think it's starting to happen now. But even if we don't, the rate cuts are good for gold. So that's the minimum. But on top of that, if recession becomes undeniable, I think that's very good for gold and silver. And then if I'm right about that breaking things, like the other shoe finally dropping on commercial real estate or some of these other things, banks marking things to market that they've been able to get away with not marking to market. If we have a reality check, we could still see the Fed break something. But even if not, the base case is still bullish for gold starting from 2,500. So, I'm not one for wild arm waving, but I am very bullish for gold. It is a very high confidence trade for me. Now, of course, gold bullion is not a speculation. It's not even an investment. It's savings, it's insurance, it's real money. And it's how I save money for the future. I'm not talking about that. I always am in the market for bullion whenever I have extra money that I want to put away for the long term. I'm talking about speculating on gold stocks. And so for that, trying to project where the market is going is very important. And I just see it as either bullish, very bullish, or super bullish as being the options. And it's very rare that you get an opportunity like that. Can I be wrong? Yes. But I'll tell you what, I'm putting my own money where my keyboard is on this.
While the gold-silver ratio tells us that silver is undervalued compared to gold, the real kicker lies in the growing demand for silver from both industrial and retail sectors. Let's break this down. First, let's talk about the industrial demand. Silver is a critical component in many high-tech industries, from solar panels to electric vehicles, and even in the medical field for its antibacterial properties. Silver is everywhere. With the global push towards green energy and sustainability, the demand for silver in solar technology alone is set to skyrocket. In fact, the Silver Institute predicts that by 2025, the demand for silver in photovoltaic cells will surpass 100 million ounces annually. That's a staggering number and a clear sign that industrial demand is only going to increase. But it's not just about industry. Retail investors are also flocking to silver. With economic uncertainty looming and inflation fears rising, more people are turning to silver as a safe haven. In 2023 alone, silver ETFs saw record inflows, and demand for physical silver coins and bars surged. It seems like everyone from individual investors to large funds is looking to hedge against economic instability by investing in silver. And here's where things get really interesting. The combination of this soaring industrial demand and the surge in retail interest creates a perfect storm for silver prices. The supply simply can't keep up with the rising demand, especially with mining disruptions and the challenges of ramping up production quickly. This imbalance is exactly what fuels explosive price movements. But what does this mean for you? It means that as the demand for silver continues to climb, prices could rise much faster than most people expect. The current economic climate, coupled with these demand dynamics, is creating an unprecedented opportunity for those looking to invest in silver. Are we on the brink of a silver shortage? And if so, how high could prices go as a result? We'll explore this and more in the next segment. And remember, if you want to stay ahead of these trends and make informed investment decisions, make sure to hit that subscribe button and join our community for all the latest updates.
I'm right about that. Then that's more upside on top of where we've come. And, it's fantastic that central bank buying, and I think other whales, other deep-pocketed investors have moved into gold. I think I may have said this, I don't know if I've said this on your show or not, but my explanation for why gold has gone up before these other factors came into play is that I think people are starting to read the tea leaves, and not just gold bugs, but like more deep-pocketed institutional and family offices, even sovereigns around the world. And I don't just mean central bank, I mean funds. They're stocking up on gold. We got two hot wars, either one of which could become World War III, and the global financial order is in disarray. The American exceptionalism makes it seem like we'll take more proof before recession becomes undeniable. But China's in trouble, Europe's in trouble. With those two big markets in trouble, the rest of the world feels, they're looking at risks. And so, Rick Roll's famous thing about global average over the decades is being like 2% allocation to gold, and it's only 0.5% now. I think that's what we're starting to correct. I think more people are starting to say, they're not becoming gold bugs. They're just saying, you know what, I have no gold in my portfolio. Would it hurt to buy a little as insurance? So I can't prove that. This is my theory for what happened earlier this year, why gold went up without really the economic drivers to make it go up. But now those economic drivers are coming into play. So I do think we go up from here. Yes, that's a forward-looking statement. Yes, I can be wrong, but that is what I think, and that is how I'm speculating with my own money.
Let's take a closer look at the game changer here. The Federal Reserve's recent decision to cut interest rates by a full 0.5 percentage point. This move was more aggressive than many expected, and it sent shockwaves through the financial markets. But why is this rate cut so important, especially for silver? When the Fed cuts rates, it's essentially making money cheaper to borrow. This stimulates the economy by encouraging businesses and consumers to spend more. But there's a catch. Lower rates also mean lower returns on traditional savings and fixed income investments like bonds and CD. So where do investors turn when the returns on these safe assets become less attractive? They look for alternatives that can offer better protection and growth potential, and that's where silver comes into play. Historically, silver has performed exceptionally well in low interest rate environments. This is because the opportunity cost of holding non-yielding assets like silver decreases, making it a more attractive investment. And with this recent rate cut, we're already seeing the early signs of a shift. Just days after the Fed's announcement, silver prices jumped above $31, breaking through key resistance levels and signaling a potential new rally. But it's not just about the immediate price bump. The Fed's decision suggests a broader strategy of monetary easing to support the economy, which could include additional rate cuts in the near future. If this happens, we could see even more money flowing into silver as investors seek to hedge against the risks of inflation and economic uncertainty. So, what does this mean for the silver market moving forward? It's like a perfect storm: low interest rates, growing industrial and retail demand, and a potentially weakening dollar. These are all factors that could push silver prices to new heights. But here's the big question: is this just the beginning of a much larger trend? Could we see silver prices continue to climb as the Fed navigates this complex economic landscape? We're going to dive into some expert opinions, including Lobo Tiger's take, in the next segment. And trust me, you won't want to miss what he has to say about where silver could be headed next. So if you're finding this information valuable, be sure to subscribe and hit the notification bell to stay updated.
Well, first and foremost, I think it's a mistake to just look at the indices. And sorry, but it's a stock picker's market. And, I have done better than the indices this year. The gold stocks, even with the indices, they have responded to gold. They haven't delivered the kind of leverage we'd like to see so far. There's a free article on my website called Are Gold Stocks a Broken Asset? Or Are Gold Stocks Broken? Or something like that. It's a free article you can search for on the website. But I make the point that, and this is also a Rick Rule thing, in some ways the industry deserved the discount. They failed so spectacularly to deliver for shareholders in the early aughts, right? The ramp up from 258 to 1911. Gold from 2001 to 2011, right? They failed so spectacularly to succeed in the actual business of mining gold and making money for shareholders that it's not unreasonable for investors to look at them with skepticism now. And so that's another interesting thing, and I think a particular source of opportunity, because the stocks and the companies facing the skepticism, they have not really moved as much as we would think, expect, or hope as speculators. But I think they will. In Q1, we had the biggest gold producers in the world. They all beat expectations. We're into Q2 now, and we're starting to see good results too. So I think we're getting to the point where even the Warren Buffetts of the world could look at the gold mining business and say, I get it. That makes sense. They have these producing assets, the margins are increasing, and there's a huge moat. It takes years and years and years to explore, permit, build another gold mine. So it fits, in my view, that Warren Buffett-y sense of looking for a great business that competition can't just jump in and swamp them out.
Now, let's bring in the expert perspective that's been making waves. Lobo Tiger, also known as the independent speculator. Lobo has been closely following the silver market, and his recent analysis is nothing short of eye-opening. He believes that the recent Fed rate cut could be a spark that ignites a massive silver rally, but his reasoning goes beyond just the numbers. Lobo points out that while gold has been the traditional go-to for investors during times of economic uncertainty, silver is now stepping into the spotlight. Why? Because it offers what he calls a dual opportunity, both as a safe haven asset and as a key industrial metal. According to Lobo, this unique combination positions silver for even greater gains than gold in the coming months. But here's the kicker. Lobo isn't just bullish because of the Fed's recent actions. He's looking at a convergence of factors that he believes make this one of the best setups for silver in decades. He highlights the tightening gold-silver ratio, the surging demand from both industrial and retail sectors, and the looming threat of inflation. All these elements, he argues, are creating a perfect storm for silver. Lobo also points out that while many investors are focused on gold, they're overlooking the potential in silver. He believes this is a huge mistake. Silver is not only playing catch-up to gold, but it's also poised to potentially outperform it. He even suggests that we could see silver hitting new all-time highs if these trends continue. And if that's not enough, Lobo warns that the Fed's aggressive rate cuts could be just the beginning. He suggests that we might see further monetary easing if economic conditions worsen, which would only fuel a fire for precious metals like silver. He's already seeing signs that the market is starting to price this in, with silver ETFs seeing significant inflows and physical silver demand spiking. But what does this mean for you as an investor? Lobo is clear. This could be a rare opportunity to get in on the ground floor before silver really takes off. He advises keeping a close eye on the Fed's next moves and being prepared to act quickly as the situation develops. So, do you agree with Lobo's bullish outlook? Are we on the verge of a historic silver rally? Let us know in the comments. And don't go anywhere. Next, we'll explore some potential scenarios for silver prices in the near future and what they could mean for your investments. If you're enjoying this deep dive into the silver market, make sure to subscribe and hit the notification bell so you don't miss out on any updates.
And in a context where if I'm right about gold itself going up, then that moat is highly relevant. Your competition, let's say even if you have a mothballed gold mine, you're an existing miner, you've got the know-how, you've got people on staff, and you can go back into production lickety-split. Well, in the mining world, lickety-split means like 6 months or a year. So, that moat is tremendous for the people that have the goods now, the profitable miners. So I think we're in a situation where we may see that skepticism about the gold miners and the gold stocks fall away. And if nothing else, just, we're at nominal all-time highs now. You start going way above that. I mean, a mere 20% rise from where we are now takes us almost to $3,000 an ounce. That would have screaming headlines left and right. That would have generalist investors saying, how can I jump in? Even young people, Elijah. I don't know if your friends have talked to you about it since you do this sort of thing, but I teach economics and entrepreneurship, and young people are interested in gold. They're not religious about cryptos or this, that, or the other. They're just looking for things that will work. And headlines about all-time highs in gold have them asking me questions that they never asked before. Suddenly they want to know about gold. So now imagine that going forward if I'm right about the other things that I've said. So I think it's actually, I know that it's going out on a limb. Yes, it's speculation. My publication is not the independent sure thing can't lose ever.com, right? It's the independentspeculator.com. I think it's a fantastic speculation. When the underlying asset is already showing huge strength and the securities are still lagging behind, that gives you a chance to buy. You're not buying high and hoping to sell higher. You still have a buy low opportunity.
Let's explore some potential scenarios for where silver prices could be headed in the near future. There are a few different paths that silver could take, each influenced by key factors like the Federal Reserve's policy decisions, economic conditions, and global demand trends. Understanding these scenarios will help us see just how high silver might go and what could trigger these movements. Scenario 1. The steady climb. In this scenario, the Fed continues with a gradual rate-cutting cycle, and the economy experiences moderate growth without major shocks. Silver benefits from the ongoing demand in industrial applications, especially in green energy and electronics, while retail investors continue to seek it as a safe haven. This would likely result in a steady but significant rise in silver prices, potentially reaching $40, $50 an ounce over the next 12 to 18 months. It's a conservative scenario, but one that still offers substantial upside compared to today's prices. Scenario 2. The breakout rally. This is the more bullish case, and it's where things get exciting. If the Fed decides to cut rates more aggressively in response to a worsening economic situation or a significant downturn in the stock market, we could see a rapid influx of capital into precious metals. Couple this with a surge in industrial demand, and silver could break through its previous all-time high of $50, climbing towards $70 or even $80 an ounce. This scenario is driven by both fear and opportunity. Fear of economic instability and the opportunities seen in silver's undervaluation compared to gold. Scenario 3. The moonshot. Now here's the most extreme scenario. Imagine a situation where the global economy faces multiple shocks: a deep recession, geopolitical tensions, and further devaluation of major currencies. In this case, the Fed might resort to unprecedented monetary easing including potentially negative interest rates. Such conditions could send investors flocking to silver as a safe haven, driving prices to levels we haven't seen in our lifetimes. We're talking $100 an ounce or more, a true moonshot scenario. While this may seem far-fetched, it's not entirely out of the realm of possibility, especially given the unprecedented economic policies we've seen in recent years. So what's the most likely scenario? It's tough to say, but the common thread is clear. In each case, silver is poised to benefit. The key takeaway here is that whether it's a steady climb or an explosive rally, the conditions are ripe for silver to outperform in the coming years. But here's the big question for you. Which scenario do you think is most likely? And how would you position your investments if silver does start to rally? Share your thoughts in the comments below. Next, we'll dive into some practical investment strategies for capitalizing on these potential silver scenarios. If you're enjoying this analysis, don't forget to hit that subscribe button and ring the notification bell to stay informed about the latest market trends and opportunities.
Silver. my thesis that got me called Darth Silver was never a bear case for silver. It was a future-looking case about whether or not silver will actually ever go back into circulation as money, since digital receipts solve the problem of making change for gold. I'm not sure that it will, but set that aside. We can let history decide that. Silver has been acting more like an industrial metal. Clearly, its industrial use case has changed and it really exploded. I actually see this as a good thing. That hasn't made it stop being a monetary metal or a safe haven asset. It still works that way, but it also has this other possibility. I think on the other side of the recession, once we're sure that any potential downside due to the industrial side is off, I see silver as the win-win metal. I think both the monetary and industrial aspects in an inflationary environment where the powers that be are blasting with the money bazookas left and right, I think silver does really well. Oh, and by the way, it's an essential part of the green agenda too. So whether you like that or not, it's happening, right? And it's another tailwind that really doesn't affect gold, but is a tailwind for silver big time. All of that said, last year silver did correlate more closely with copper than gold. That's just a mathematical fact. You can do the numbers and look it up. The good news is that silver has been tracking gold more again this year, particularly on, it's interesting to me, on like geopolitical events where fear makes people go into the dollar and gold at the same time. Silver tracks gold then. So the world is still treating silver as money, which is good. But it has been underperforming, right? We keep getting nominal all-time highs in gold, but we haven't had a new nominal all-time high in silver yet. I was just talking with David Lynn, and he showed me a chart where it looked like silver was correlating more with gold than I had thought this year. But in the last couple of months, the alligator jaws have opened. So no matter how you look at it, there is data out there that tells us that silver is behaving differently than past cycles, and its industrial side is changing its trajectory. So in that context, it makes me a bit nervous. I still like it. I'm still bullish. I'm still willing to buy a great silver stock if I can find one. And that's the hard part, the finding a great one. But I have to say, I'm more confident in gold. I see it as less risky in front of the recession. After the recession, I expect to have a greater emphasis on finding more silver stocks in my portfolio than gold. But right now, in front of the recession, I'm trying harder to get more gold in there than silver.
If you're thinking about how to position yourself for a potential silver rally, there are several strategies you might consider, depending on your risk tolerance and investment style. One of the most straightforward ways to invest in silver is by buying physical silver, like coins or bars. This approach gives you direct ownership of the metal, which many people find reassuring, especially in times of economic uncertainty. There's something tangible about holding silver in your hands, but you'll need a safe place to store it, and you may have to pay a premium over the spot price. For those who prefer a more liquid investment, silver ETF could be the way to go. These funds track the price of silver and allow you to gain exposure without the need to physically own it. ETF are convenient and easy to trade, making them a popular choice for many investors. However, remember that you don't actually hold the silver. You're investing in a financial product that represents the metal. If you're looking for even higher potential returns, investing in silver mining stocks might be worth considering. When silver prices rise, mining companies often see their stock prices increase even more because their profitability goes up with the price of the metal they produce. Companies like First Majestic Silver or Pan American Silver are well-known players in this space. But be aware that this strategy comes with additional risks, as mining stocks can be more volatile and are affected by factors beyond just the price of silver. Another interesting option is to look at silver streaming companies. These companies provide financing to mining firms in exchange for a portion of their silver production at a fixed, lower cost. This model allows them to benefit from rising silver prices without the direct operational risks of mining. It's a unique way to gain exposure to silver with potentially less risk than traditional mining stocks. For more experienced investors, options and futures contracts can offer a way to speculate on silver's price movements with a smaller initial investment. These instruments can provide significant leverage, meaning you could see large gains if silver prices move in your favor. But they also come with substantial risk, and you could lose your entire investment if things don't go as planned. This strategy isn't for everyone, and it's important to fully understand the risks before getting involved. Of course, you don't have to stick to just one approach. A diversified strategy that includes physical silver, ETS, and maybe some exposure to mining stocks could help balance the risks while still allowing you to take advantage of potential gains in the silver market. The key is to find a mix that aligns with your financial goals and risk tolerance. But which approach resonates with you the most? Are you leaning towards the safety and tangibility of physical silver, or are you more intrigued by the potential high returns from mining stocks? Or perhaps you're considering a combination to cover all bases. Share your thoughts in the comments below. In our final segment, we'll tie everything together and discuss why now could be a pivotal moment for silver investors. If you're enjoying this deep dive, don't forget to subscribe and hit the notification bell to stay updated on the latest trends and opportunities in the market.
All right, there's several threads there. One is, I had initially somewhat discounted the AI craze. You have these things, the dot-com boom and, these crazes the market goes into, they always seem to fizzle, and then you figure out who the winners are. And a decade later, it becomes a real business and money's being made based on these things that had been a flavor the day before. This worries me about this. But the data center build-outs is real. That's happening now. And the energy demands that those things require is real. That's happening now. And this is a use where, it's not optional. You can't just operate these things at half power or something. You can't have a brownout rolling through your data center. And you can't just turn them off at night or something, right? At night for you here is daytime across the world. So these things need reliable 24/7, 365 power, which doesn't come from windmills or solar panels. Nuclear is ideally suited for this. But you know what? Even if none of that pans out, I do think that that's a real case. That's a tailwind, a new tailwind. It's not in any of the existing uranium supply and demand models, and I think it's extremely bullish. But let's say it's all a load of dingoes' kidneys. Tomorrow, Intel invents a super energy efficient AI chip that just puts NVIDIA out of business or something. Who knows? Let's say it all changes direction. We're still building nuclear power plants, as fast as we possibly can. Just recently, China, which is already building scores of them, announced 21 new reactors. This isn't just an idea or this is we're building these more. So it's just boom. The demand side, I sincerely think it would take a Chernobyl scale event to derail the demand side. Meanwhile, the supply side is still taking time to sort itself out. Yes, high prices cure high prices. Yes, that's happening now, this year, right now, as you and I speak. Existing producers are ramping up production. Mothballed production is coming back online. Low-hanging fruit of high-margin projects are being built. This is all happening right now, but it's not enough. Even if it was all done completely according to plan and on schedule, on budget, and all that stuff, it would not be enough to meet the demand. And it's not going well. I mean, mining is a crappy business, really. Doug Casey famously calls it a crappy 18th century choo-choo train industry, right? It's so difficult. Even when things go well, it just means relatively well, right?
So where does this leave us? With the Federal Reserve aggressively cutting rates, the gold-silver ratio tightening, and both industrial and retail demand surging, all signs point to a perfect storm that could propel silver prices to new heights. The conditions we're seeing now are unlike anything we've witnessed in decades, making this a truly unique moment for silver. Think about it. The gold-silver ratio, which has historically been a reliable indicator of silver's value relative to gold, still suggests that silver is significantly undervalued. If the ratio were to revert to its historical average, we could see silver prices surge well past $50 an ounce. And if we factor in inflation adjustments, the target price could go even higher, potentially reaching levels that seem almost unimaginable today. But it's not just about historical trends. The economic landscape is changing rapidly. The Fed's aggressive rate cuts are not just a reaction to current economic conditions. They're a signal of concern for what might be coming next. Lower rates weaken the dollar and increase inflationary pressures, both of which are highly supportive of precious metals like silver. And with the possibility of even more rate cuts on the horizon, this could just be the beginning. Then there's the demand side of the equation. Industrial demand for silver, especially from the green energy sector, is set to explode over the next few years. This is not a speculative trend. It's a structural shift that will likely keep demand high regardless of economic fluctuations. At the same time, retail investors are flocking to silver as a hedge against uncertainty, driving up demand for physical silver in ETF. All of this suggests that we could be on the verge of a significant silver rally, one that could see prices reach levels we haven't seen in decades or maybe even ever. For those who position themselves wisely, this could be a rare opportunity to not only protect wealth, but potentially grow it in a way that few other assets can offer right now. So, what's the takeaway here? The stars seem to be aligning for silver, creating a potentially explosive investment opportunity. But as always, it's crucial to do your own research and consider your financial goals and risk tolerance before making any investment decisions. While silver has enormous potential, it's also a volatile market that requires careful consideration. If you found this analysis helpful and want to stay on top of the latest developments, make sure to subscribe to our channel and hit the notification bell so you don't miss any updates. And remember, this is not financial advice, just a deep dive into a market that's showing some incredible potential. Stay informed, stay prepared, and as always, make your decisions wisely. Thanks for watching, and we'll see you in the next video.